Unit 14, Investment Financing Strategies. Sale-leaseback strategies are actually fairly common. In this case, an owner sells a piece of property to an investor, but at the same time leases back to continue running their business or whatever that may be. So it's beneficial for the seller because they can maintain their business and keep their business running in their property. As far as the investor landlord goes, advantageous to them because they bought an investment that is a depreciable asset and has a guaranteed income stream. Where it becomes more common, though, is in residential, where you see people with time differences, a buyer and a seller. Maybe the seller can't move in for 30 days or so, and the buyer has movers coming or is getting transferred, but they need a month. So you'll see this commonly in residential properties as well, where someone may come in and purchase a property and close, but then do a short-term seller leaseback to the previous owner of the property. They stay in the property for, say, 30 days and then move on, and the new buyer moves in. Seller refinances prior to close. This is a very bad idea and borders and probably could be determined as fraud. Because if a seller refinances a piece of property to a bank, the bank's assuming they're going to own that piece of property. Number one, especially if it's owner occupied, you're telling somebody that you're refinancing the property and this will maintain or maintain your primary residence. When in fact, you're already thinking about selling it to somebody and let the buyer assume the loan. Well, here's where more problems come in. We already talked about the question of occupancy for the seller. But if somebody wants to purchase a piece of property and refinance it, there's some time limits they have to respect. And the first one is to get cash out of the property. You normally have to wait 6 months before you can pull cash out on a piece of property. Uh, but in all, the seller is not being honest with the lender when they're going to refinance a piece of property and let somebody else assume that loan. Especially today, after a mortgage crisis back in the early 2000s, most loans are not assumable. And if they are assumable, they're assumable with qualification. So that would mean if somebody was going to assume your FHA loan, they would have to submit a package to that lender who is servicing the loan and qualify to take over that loan. Likewise, with a VA loan, you'd have to do the same thing. If you're going to assume it, you'd have to qualify to assume it and make sure you can make the payments. So that's probably not going to happen. With all conventional financing today, they are not assumable. So that's why I'm saying that. I know this is in the book, but this is not a good idea at all. Likewise, this isn't a good idea either. And what it's talking about is the seller deeding the property to the buyer and let them refinance the property to get their own loan on the property. Which, just as I say that, you're thinking, well, wait a minute. If somebody's going to refinance a piece of property, they have to own the property to refinance it. Why on earth would a seller just deed their property to a buyer coming in that you don't know can qualify for a loan? And unless the buyer gives them some money to allow them to do that, the seller's equity is tied up in that piece of property. And once again, it's limited to a buyer can't pull out cash out from that property for 6 months after they close on the transaction. So this is a very risky proposition to let somebody take over your loan. You're going to deed it to them. Hopefully you'll get some equity or some sweat in the game from the buyer before you'd even attempt that. But I know a bank would look not very positively to a transaction like this. So I would imagine you'd never ever see a transaction like this happen when you're in your real estate career. Equity participations are normally done between large entities like pension funds or insurance companies. What a lender or a pension fund or insurance company might do is purchase a piece of property from a developer, and that way they have legal title, ownership on it. They can make interest and profits and kicker, which is payment or profit from the developer, and then the the lender sells it back to the developer at 100% loan to value and the ownership interest. So basically, what happens is the developer gets 100% financing on their property, and the lender is in partnership for interest and profits on the property also. Another participation deal that you may see is when the lender or large entity purchases the land, not land for development, and finances the improvements. In doing so, they're in partnership with the developer and will make money later on financing the property and also sales proceeds and such as a partner with the developer on that property. A joint venture may be where the lender becomes an investor partner of the developer. The lender may finance the developer's needed capital for purchasing the land and also for improvements, but then later on, they're using the developer's experience and becoming a partner in the development of the property and also the sale, and thus they'll receive their partnership proceeds after the sale of the property. Tax deferred financing concepts just means you're trying to avoid capital gains. And for example, somebody buys a piece of property for $200,000 5 years ago, and now it sells for $400,000. Well, you've got a $200,000 capital gain that you have to pay taxes on it. How can I defer that or avoid those capital gains? Because recognized capital gains and profits are actually taxable. One way that an owner can do that to avoid capital gains is to refinance their properties during their lifetimes and generate tax deferred capital dollars. Basically, you're refinancing cash out, which is borrowed money and not taxable. Then you use that money to go out and invest in other investment properties that you would like to participate in. One way to defer your capital gains is also to do a 1031 exchange, where you're exchanging a like investment property for another investment property. And when you do that, what you're doing is taking your equity from one investment property and putting it into your new investment property. So if you haven't realized any capital gains, and you've just moved your ownership interest and equity into another piece of property. Once you start the process, say you sell your original investment property, you have 45 days to nominate or identify another property that you would like to put your equity into. And that from that point, you have 180 days to acquire the replacement property. The exchange is completed in 180 days total, not the 45 plus the 180 days. So it's for a like investment property. They don't have to be exactly like a single family or a duplex or another duplex. You could go for, say, a duplex and a commercial property. So what you're doing is transferring your equity. Any monies you take out of that sale is called boot. So during the closing, you might possibly realize some cash, say it's $20,000. Well, that's called boot, and that's taxable. But that's a 1031 exchange. Pyramiding is like we talked about before. It's basically refinancing the properties you have and pulling out monies to borrow from yourself. So periodically you may refinance a piece of property, pull some proceeds out, and then go buy another piece of property. People can do that in the form of a new first trust deed on the property that they own, take cash out and then put it onto another piece of property, or pull out some equity in the way of a second trust deed or a equity line of credit, and then purchase that new property. The capital gains then are delayed through refinancing because really it's borrowing. You're not earning any cash. It's not capital gains. Your refinancing may be limited by the occupancy, however. If, for example, you're doing a residential property, so you have an investment property, the access to your equity may be a little more limited in the loan to value, in that you get higher loan to values with primary residences, whereas if it's an investment property, you'll get lower loan to values because it's a little more risky in buying a property that you're not living in full time. Distribution to heirs and estate taxes. Federally, we have an estate tax, and right now it's limited to $5,450,000 per person, or double that for community property. So if it's husband and wife, Anything above that would be taxed as an estate tax to the federal government. California actually in 1982 did away with inheritance and estate tax. But what they'll do is take a credit from anything due on federal taxes toward the California state government. So they don't have inheritance or estate tax, but whatever's due to the federal government, California will take a credit from that. There is a gift tax exemption presently. You say, for example, family members wanted to gift to son or daughter, but it's limited to 14,000 per donee, so per person. If it's a couple, it can be 28,000, and that's tax free. You can take that money in. It's not earned income and it's not taxable.